9 is all about, really about business income and deductions and some exceptions to commonly held rules, because, this is tax and we have lots of exceptions to rules. So we've already talked about Schedule C and the fact that if you are self-employed and have trade or business income, you are going to need to fill out a Schedule C. So think about that in the context of your tax return project. And then also, deductions must be directly connected to business activity. Remember that in general, personal expenses are not deductible. There are a couple of notable exceptions, but in general, personal expenses are not deductible. But in order to be business deductions, your expense has to be both ordinary and necessary and reasonable in amount. And we've already talked about that earlier in the semester, but Chapter 9 reiterates that. All right, so let's talk about reasonableness. Lots of times when we talk about reasonableness, we're talking about salaries, and lots of times when we're concerned about the reasonableness of a salary, we are talking about related parties. So in this situation, and we've talked about an example like this already this semester, Rick owns a business that employs his brother Ben. Ben is paid $45,000 a year by Rick's business. In comparison, other employees with Ben's responsibilities are only paid $30,000 per year. What is Rick's business deduction for employing Ben? Well, what is reasonable? So the reasonable amount equals deductible amount, and that's going to be the comparison to other non-related parties. Okay, so then the question is, what is that additional $15,000 of income? Well, to Ben, it's a gift. To Rick, it's a gift and not deductible. Okay, so that's important to remember. You can only deduct what's reasonable. You can pay somebody really whatever you want, but you can only deduct an amount that is reasonable. So there are some statutory limits on the types of things you can deduct from a business perspective. So expenditures against public policy. So you get no deduction for fines, bribes, lobby expenditures, or political contributions. A great example of fines is years ago, Domino's used to advertise that they would deliver your pizza in 30 minutes or less. And what happened as a result of that, you had all kinds of pizza drivers driving around like crazy people and getting speeding tickets. And Domino's would reimburse their drivers for speeding tickets, and Domino's tried to deduct all of those speeding tickets as a deductible business expense. Well, they were denied because that is a fine, and they then, along with some accidents and a little bit of public outcry, those factors encouraged them to change that policy, and they no longer have a 30-minute or less guarantee for delivery services. Expenses relating to tax-exempt income, we've already talked about this. If you take out a loan and you pay interest on that loan, that interest is not deductible if the loan is invested in municipal bonds. Additionally, key employee insurance policies. You've probably talked about these in financial accounting. A key employee insurance policy is Say, for example, you have a small business and you are the CEO, then your business is going to have what's called, it's sometimes called a key man insurance policy, because if you are the sole source of knowledge or marketing for your small business, then they will take out a life insurance policy on you. And if the business is the beneficiary of the life insurance policy, then they cannot deduct the premiums. Okay, so that's important. All right, these last two things, all right, so this whole category is talking about limits on business deductions, essentially, all right? And so what do we see? We see that we may have capital expenditures, and if we have capital expenditures, these capital expenditures are not deductible. You have to capitalize them. Okay, so when do we capitalize expenditures instead of deduct? Okay, well, we have what's called the 12-month rule, okay? So if the expenditure provides a benefit beyond 12 months, okay, then we have to look at the nature of that and determine if we can deduct or capitalize. All right, so what does that mean? Okay, so we deduct if the benefit is less than or equal to 12 months and benefits do not extend beyond the end of next tax year. Okay, now a couple of things. Why do we have to have this? Well, we have to have this because we have these things that we call prepaid expenses. So for example, you buy a whole bunch of supplies, okay, and those supplies are designed to last you a number of months. Do you get to deduct the expense of all those supplies in the current year, or do you deduct them for tax purposes? Do you deduct those expenses over time? Well, this is a rule that tells you the answer to that question. Now, the other thing you need to pay attention is this rule does not apply to interest expense. Must deduct ratably over time. Okay, so let's do an example. All right, and there's an example built into our presentation. Okay, so we've got Ben, and he's a cash basis taxpayer, and he makes the following payments on June 30th. Okay, so that's halfway through the year. Okay, the question is, what of these amounts are deductible this year? Okay, so he pays $10,000 for the next 10 months of utilities. He pays $12,000 for insurance over the next 24 months. And he pays $9,600 for for the next 8 months of interest on a business loan. Okay? So, all right. So we have to decide what Ben can deduct, all right? And we have to pay attention to, so what can Ben deduct? And pay attention to 12-month rule. Okay, so let's look at utilities. All right, what do we know about utilities? All right, remember that all payments were made June 30th. Okay. All right, so utilities. He paid $10,000 for 10 months. Okay. What can he deduct? Okay, well, you got to ask yourself 2 questions. Does this go beyond 12 months? All right. So he's got 10 months of utilities that he paid for in advance. Does this go beyond 12 months? Does the benefit go beyond 12 months? No. All right. So that's the first question. Second question. Does it extend to the end of the next tax year? Does this extend to the end, or I should say, to the end of, next tax year? Does that extend to the end of next tax year? Okay, so you got June 30th and you've got 10 months. Okay, so if you're June 30th this year, 6 months gets you to the end of this year, and then you've got 4 additional months that takes you into, April of next year. Does that extend to the end of next tax year? No. All right, so what can he deduct? So for utilities, can deduct full $10,000 this tax year. Okay? So now, what's the next one? The next one is insurance. Okay? So the question is, what of that can he deduct this year? Well, what did he spend? He spent $12,000 for 24 months of insurance. Okay, so same 2 questions. Does this last more than 12 months? Yes. All right, it's 24 months. Does this last beyond next tax year? Well, it's 24 months. Yes, it does. Okay? So, what does that mean? So, what that means then is you have to deduct for this year. Okay? So, we've got $12,000 of insurance over 24 months, which means we have $500 per month. Okay? And so what do we have for this year? We've got 6 months left this year. Insurance deduction equals 6 times 500 equals $3,000. Okay? So that takes care of insurance. Next, we have to worry about interest. All right? Now, interest. Do we care about the 12-month rule with interest? No, we do not. For interest, we do not care about 12-month rule. All right? So what do we have? We have $9,600 of interest over 8 months. What does that give us? So that gives us, $1,200 per month. Again, 6 months. 6 times, that's 12,000. Got to get rid of a 0. There we go. So $7,200 equals our interest deduction for the current year. Next year, we'll be able to deduct the rest of the interest, the other 2 months of interest, okay? So this just governs what you can deduct this year currently. All right? So what do we have? Well, we've got some special business deductions, okay? Losses on the disposition of business property. Now, lots of times we think of disposition as a sale, but disposition can be, voluntary or involuntary, okay? So an involuntary example would be a casualty loss. So say you had a delivery vehicle that got in an accident, okay? Your casualty loss is limited to the lesser of decline in value or basis, whichever is less, obviously, and then basis amount is the amount that you get for your loss if it's completely destroyed. All right. What about business expenses with personal benefits? All right. If it is a purely personal expenditure, typically you cannot deduct them. There are things that are given legislative grace, and we're allowed to deduct them to a certain extent, okay? Then there are things that are called mixed motive expenditures. So some mixed motive means some part is related to business, but part is personal, okay? So, for example, travel is a great example of this, okay? Say, for example, I go to a conference for tax professors, okay? That has a business-related motive. But if it's in a really cool location, like New York City a couple of summers ago, I took my kids and my husband went with me to New York City, okay? So that would be a mixed motive trip, okay? So there are specific allowances for what you can deduct if your expense is mixed motive. The key in these situations is record keeping. That way you can document that even though your family went with you, you were there for a legitimate business purpose, okay? So let's do this example that's in the presentation. And we've got Ben again, and he paid to attend a business meeting in Chicago. So he's got airfare, he's got hotel, and he's got meals. And what amounts are deductible if Ben spent 2 days in meetings, primarily business? So this trip then would be primarily business because he's got 2/3 of the time are business related. And what is deductible if Ben spent 1 day in a meeting? That makes his trip primarily personal. All right, so I'm going to head to the next slide so I have room. Now I'm on the next slide so I have more room to write. Okay, so let's look at two situations. 2 days of meetings. Primarily business. 1 day of meetings. Primarily personal. Okay? So we have airfare, hotel, and meals. Okay? So airfare, let's look at airfare. Airfare is an all or none deal. Okay? So if you're primarily personal, you get to deduct your airfare. Excuse me, if you're primarily business, you get to deduct your airfare. If you're primarily personal, you do not. Okay? Hotel. Well, remember the hotel was $250 a day. So the days that are related to business, you get to deduct. So that'd be 250 times 2 equals 500. Remember, on our primarily personal, you can still deduct those expenses, but only the ones that relate to the business purpose. Okay? And then meals, we had 3 days and 270, so that's $90 a day. Okay? But remember that meals automatically, you only get to deduct 50% of anything you qualify for. So we've got 90 times 2, or I got to erase that. There we go. Times 50%. Okay. And so that equals 90. And then in our primarily personal trip, you've got 1 day of meals times 50%. So that equals 45. So our total deduction, if our trip is primarily business, is $1,790. Our total deduction, if it's primarily personal, is $295. And so what's the big deal here? The big deal is airfare. If it's a primarily business trip, then you also get to deduct airfare. If it's primarily personal, you do not get to deduct airfare. Okay? So move right. Whoops. Along to accounting periods. All right. And we've already talked about this a little bit, some aspects of this, I guess. So accounting periods. All right. A full tax year is 12 months. A short tax year is something less than 12 months for year ends. If you're a calendar year end company, then that's 12/31. And then if you are a fiscal year end company, you can choose something that relates to your business purpose. Individuals, we know we're all calendar year taxpayers. Okay. There are requirements for entities when they choose an accounting period. So proprietorships have the same accounting period as a proprietor. So that would be a calendar year end. C corporations and individuals The choice is made on the first tax return and has to be consistent with their book accounting period. So that obviously is for C corporations. Flow-through entities have a required tax year, and they have to match to the owner's tax year. If you have multiple ownerships for partnerships, example, this can be really complicated, but what you have to do essentially is figure out what the tax year is for the majority of your owners, and then figure out which tax year will cause the least amount of difference between you and the majority of your owners. So that can get complicated. That is actually a calculation for the entities class that I teach in the fall. So you guys don't have to do that calculation in this class. All right. So what about accrual income? Okay. We know from financial accounting that income is recognized if you're on the accrual system when it's earned or received. So with accrual income, you've got the all events test. So you recognize income when all the events have occurred, which fix the right to receive such income, and you can determine the amount with reasonable accuracy. And remember that that's going to be the earliest of one of three dates: complete of service or sale. So from an accounting perspective, when is the audit done? When have you completed the tax return? Okay. When payment is due, or when payment is received. Okay. Whichever is the earliest of those then completes the all events test to recognize income. Now, what about prepaid income? Because prepaid income, from a tax perspective, brings with it some unique instances. So we know what prepaid income is, right? If you have advance payment for services. Okay, so if you get advance payment for services, say for example, you are a house painter and you're going to paint somebody's house, and it's going to take you, 3 weeks to paint their house, and they pay you up front for the full amount, or they pay you up front for a significant portion of the full amount. Okay, you're allowed to defer recognition of income for a year unless the income is earned or recognized for financial records. All right. So, for example, say it was going to take you 3 weeks to paint someone's house, and you were starting the last week of December. So that was going to span years. Okay. You're allowed to defer the recognition of that income from one tax year to the next. All right. Unless you recognize that income for your financial records. If you recognize that on your financial records, then you have to recognize it in the current year. Note that there's an exception for rent and interest. Okay, you cannot defer income related to rent or interest. You have to recognize rent income. You have to recognize interest income. Okay, you cannot defer that for a year. What about advance payments for goods? Okay, so you've got one of two methods of recognition. So you've got either full inclusion or the deferral method. Okay, full inclusion says you recognize prepayments as income. So say, for example, you are purchasing some type of large earth moving equipment, and you pay the full amount. And then you receive the goods the next tax year. All right. That company would recognize those prepayments as income. Okay. And if they use the full inclusion method, if they use the deferral method, then they're going to include them in the period earned for tax or financial purposes, whichever. So essentially you have to match those up. Okay. So let's look at an example. All right. So we've got Ben again. Ben's a busy guy. And now he's providing dancing lessons. And on September 30th of this year, he received $2,400 full payment for a 2-year service contract. So somebody paid him up front, and they're going to take 2 years of dance lessons. What amount of income must be recognized if he's on the cash method or if he's on the accrual method? Okay. Well, if he's on the cash method, what do we know? Somebody pays him $2,400 on September 30th. Even though it's for a 2-year contract, if he's on the cash method, I can't spell. He must recognize $2,400 income this tax year. All right. What if he's on the accrual method? Okay. Well, if he's on the accrual method, then he can elect to defer advances for a year. Okay. So what does that mean? Well, he has to recognize what's related to this year, but he can defer the rest for 1 year. So if he's got on September 30th, all right, so it's a $2,400 over 24 months. So what does that tell us? It's $100 a month, right? All right, and so this year, he recognizes income related to October, November, and December. So that's 3 months. So that equals $300. All right. Next year, he recognizes the rest of it. So 2,400 minus 300, which equals $2,100. Okay. So that's Ben and his dancing lessons. Now, just to make it a little bit more complicated, because again, this is tax and we like to do that, inventories must be accounted for under the accrual method if the sales of goods constitute a material income producing factor. So if you have the sale of inventory as a material portion of your business, you have to take care of inventories and the accounting under the accrual method. Okay, so that means you have to have an accounts payable and you have to have an accounts receivable. Okay, if you're a cash method taxpayer, you can use the cash method for all other non-inventory accounts, but if inventories are a significant portion of your business, they have to be taken care of under the accrual. All right. When we talk about inventories, we have to talk about cost flow methodologies and inventory flow assumptions. FIFO, LIFO, and specific identification work exactly the same in the tax world as they do in the financial world. Okay. The interesting thing about using LIFO is if you use LIFO for tax purposes, you also have to use it for financial purposes. All right. This is called the book tax conformity rule. And the reason that this is the case is because LIFO generates the lowest taxable income if we're talking about an inflationary period, which almost every period in U.S. history has been inflationary. Okay. And so because it generates the lowest taxable income, you also have to generate a low financial income. And so that's the book tax conformity method. And that is all we have to talk about as far as inventory flow assumptions. All right. What about accruing business expenses? We've talked about revenue. What about business expenses? We've got the all events test. okay? And then you have to make sure that along with the all events test, economic performance has to have occurred. So when we talk about economic performance, what do we need to have happen, okay? Well, economic performance, remember, only applies to accrual method taxpayers, okay? If you're providing goods or services, then economic performance occurs as the taxpayer provides goods or services. If the taxpayer is using property as goods, performance occurs when goods or services are provided, okay? Or economic performance is otherwise expected within 3.5 months of payment, all right? Payment liabilities are performed only when paid, and interest and rent occur ratably. Again, interest and rent, okay? Remember, interest and rent disobey all the rules for the other methodologies we've talked about. All right, and here is our last example in the Chapter 9 PowerPoint, okay? So we've got Ben again, and Ben has signed a binding contract for Peter to provide Ben with repair services, okay? So Peter is going to provide Ben with repair services. Ben is paying Peter $1,500. You already paid Peter $1,500, and he owes him an additional $6,000 on the contract. The repairs are going to start late next year, okay? When can Ben claim the deduction if he uses the accrual method, okay? Here we go. So even though, I want the other pencil. Even though the all events test is satisfied, Ben can only deduct the $7,500 next year, all right? And why is that? Because even though you've got the all events test satisfied, you also have to have economic performance. And he can only deduct $7,500 next year because that is when economic performance will occur, okay? Because it says the repairs will commence late next year. All right, that's it for kind of the lecture portion of Chapter 9. We will do some Chapter 9 practice problems. Chapter 9 practice problems are posted in the files section of our Canvas site. And then we'll work through a couple of them together via Zoom. All right. Have a good night, y'all.